Welcome, everyone. Hello. My name is Maria Tranquilli, and I'm a program manager at the Nasdaq Entrepreneurial Center. For those of you who may not know, the Nasdaq Entrepreneurial Center is a nonprofit dedicated to enabling entrepreneurs from all over the world to realize their maximum potentials and grow. We will open up for live Q&A at the end of this event, so please submit your questions in the Q&A function or the chat at the bottom of your screen throughout this presentation. And none of what we do could be possible without all of the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, KPMG, Wilson Sonsini, Woodruff Sawyer, BPM, NZTE, and Microsoft for Startups. We are humbled by their contributions. During these unique times, we are curious about sentiment and how you are feeling as entrepreneurs and founders within our community. We'd like to start by taking 2 different polls to let us know how you are feeling and what you are thinking about right now. So I'll launch those 2 polls. How are you feeling and what is keeping you up at night? Please let us know. Are you feeling fearful, anxious? Are you surviving or optimistic? And what is keeping you up at night? Is it finance, sales, marketing, scaling, pivoting, your team, or surviving? Thank you all so much for submitting your questions. I'll end the poll in just 1 second. All right, ending the poll now and sharing those results. It looks like we have a very optimistic community here today, along with finance as to what's keeping you up at night. Thank you so much for submitting your questions, or I'm sorry, your responses there. It helps Nasdaq Center understand where you are so we can continue to deliver programming like this one. So without further delay, please join me in giving a warm welcome to our special guest, Nathan Beckord, CEO of foundersui. Nathan, thank you so much for joining us today.
Hello, hello.
Welcome. I'm handing it to you.
Great, thanks. I'm excited to see that there's a skew towards optimism on that poll. I feel pretty optimistic myself, so that's great to see people are, looking forward. Very good. Well, thank you so much for having me. I'm going to go ahead and share my screen and get into the first talk here, which is funding hacks. Let's see here. Apologies. There we go. All right. Well, thank you so much for having me. It's truly an honor. I did a variation of this talk a couple years ago at the actual Nasdaq Entrepreneurial Center, the physical place, which if you haven't been there, it's awesome. Hopefully we can return to doing events there before too long, but it's kind of fun to do this over Zoom. Just very brief background. My name is Nathan. I run a startup called foundersui. We make a set of tools and database for raising capital used by about 2,000 startups each month. We've been around about 5 years, and our customers have raised about $2.5 billion in seed and venture capital, so that's pretty exciting for me. Before starting foundersui, though, I spent about 10 years running a business called Venture Archetypes, helping startups raise capital. And this talk is a lot of those lessons I learned from, basically 15 plus years of helping companies and startups raise capital. So I always like to start off with how not to do it. Hunter Walk is a VC here in San Francisco, and I just like this tweet. Will you intro me to investors? Is too broad a question to be acted upon. But this is how a lot of founders approach fundraising, is they just start asking everyone they know if they can introduce them to investors. And while that's sort of a logical, intuitive approach to fundraising, the problem is, as Hunter says, it's too broad, too ambiguous an ask. It's also putting the hard work of figuring out who you should be targeting on the shoulders of the other person, when really that's your job as the CEO. So instead of doing it in this kind of ambiguous, unfocused way, I like to think about fundraising as just another sales process. If you've ever been in sales, especially B2B sales, It follows a pretty straightforward approach where you're building a list of leads or prospects or targets. You're qualifying those leads, you're engaging with them, and ultimately you're trying to drive them towards a close, towards a yes or no decision. We can expand on this as it applies to fundraising, and we think about kind of our sales funnel or our fundraising funnel. Top of the funnel, we're building that large target list of potential investors. Then we're screening, filtering, qualifying that list. And then especially if you're going after venture capital, you got to find the right person at each fund, a decision maker, someone who does your type of deals. And then the fourth little tier down, this is where it differs a little bit from traditional sales in that fundraising is all about the warm introduction. We're going to talk about that a little bit more. Those introductions lead to pitch meetings. You're doing well in your pitch meetings. You're getting into term sheet discussions and due diligence. You get through due diligence. You execute the share purchase agreement, sell shares of your company. Really, this is just another sales process, and it can be learned and mastered by basically anyone. And I find that when we break it into this sort of step-by-step approach, it takes away a lot of that anxiety that a lot of founders have about raising capital. So let's go through a few steps here. Especially if you are at the early stages, raising an angel, pre-seed, or seed round, fundraising is really a numbers game. When I raised our seed round for foundersui, I pitched over 200 investors and ended up with one venture capital firm and 10 angels coming in to do my deal. If you do that math, that's about a 5% conversion rate between the number of investors I pitched and the number that wrote me a check. 5% conversion rate is actually pretty typical. That also means I got rejected 95% of the time. Sometimes that's a shock for founders who've been successful in other areas of their life, but that's the reality of fundraising. You're going to get rejected 95% of the time. That further emphasizes why you need a really healthy top of the funnel. So a couple places to build this target list of investors. Remember, we're aiming for 200, maybe even 300 names, top of the funnel. AngelList, great place to start. I want to say is about 35,000 investors on AngelList. A lot of angels, but also a lot of VCs on there. You can search by market, by location. Some of the unique ways to search that I think are kind of clever is school. You want to find angel investors that went to the same university you went to. That's a great icebreaker, right? Or company. Did you work at, a large firm that spun off a lot of angels? That's another great icebreaker. So good place to start building that list. A couple subliminal product placements in here. Try not to make it too salesy, but within foundersui, we have a very large database. We've been building out about 40,000 funds, about 100,000 angels. We've collected all these investors and then tagged them with type of investor like angel, VC, corporate VC, family office, by industry, SaaS, marketplace, so on and so forth, and by location typically by city. And then we've gathered a description, previous investments, contact information, and then social links so you can do a little more research on each prospect. And you can use like the previous investments to kind of get a feel. This first one displayed here, obviously doing early stage seed deals, Series A. The second one here, Vulcan Capital, obviously doing later stage deals. So you can kind of get a feel for stage. You see someone you want or see someone that looks interesting, spend a little more time clicking on the icons to check out their website, check out their LinkedIn page. If they look good, add them to your target list by clicking the green button. So feel free to poke around there. CrunchBase is another good resource to use when I'm building this target list of investors. The way I like to use CrunchBase is I make a list of a dozen or so companies that are similar but not directly competitive, but the same space, just not directly competitive, and I plug them into CrunchBase one by one to see who funded them at the relevant stage I'm at, right? So if I'm raising a seed round, maybe I'd pick out Ella Fund and Draper Associates as good prospects. Another way to use CrunchBase is if you have an investor already, or you get one, plug them into CrunchBase and you can see who they co-invest with. So lots of other places to be building this target list of investors. This first bullet here, Our newsletters you can subscribe to, they're free. I like Strictly VC, but they're all pretty interesting in their own way. And when a startup raises capital, they often announce it in here so you can see who's getting funded and who's backing them. Also, when a new venture fund is formed, or when a venture fund raises a new fund, they usually announce it in these newsletters so you can see who's got fresh capital to put to work. That's the best venture fund to be pitching, is one that just raised a new fund. Conferences, obviously not a lot of conferences happening right now, but you can go back to conferences in your space, find their web pages. If you're in blockchain or cannabis or whatever your space is, find the conferences in your space, go look at the speakers and agenda. And a lot of times you'll find that investors, like to build their own brand by getting out there and speaking at conferences. Quora, TechCrunch, Medium, Twitter, these should all be pretty obvious. Quora, people have, assembled a lot of lists about investors. Twitter is actually a really interesting place. It's kind of, a lot of VCs are getting really active on Twitter, so you can kind of see what people are doing, what type of deals they're doing, so on and so forth. PitchBook and CB Insights are paid databases, fairly expensive. I want to say PitchBook starts around $15,000 a year, and I think CB Insights is even more. But they have really deep data. You can get things like valuation on certain deals, who is the lead investor, who is the follow-on investors, things like that. And then I'm going to show you a couple ways to mine your own personal network to be building your pipeline of investors. So let's first start with LinkedIn. This is my LinkedIn page. I do have a paid plan, but this works also on free plans. So what I want to do is just come up here and do a fairly generic search on something like angel investor. And then let me pick people. So about 91,000 results. Obviously that's huge results. That's too many to really do anything with. So what I want to do is apply a couple filters. At first, I might do a search just on my first degree connections to see what angel investors I'm directly connected to. But for kind of prospecting purposes, let me do second degree. And let's do San Francisco Bay Area. So still fairly large results, 3,900. But this means that there are 3,900 people that are in the Bay Area that have the word angel investor in their title that I have at least one mutual connection to. So theoretically, I should be able to get in contact with any of those people because we have some mutual connection. That doesn't mean that all 3,000 of these people are relevant for me. So what I would do next is just kind of scroll down the list, and anyone who looks potentially relevant, I'll command click or right click, open them up in a new tab. I'm just kind of picking people at random, but I might open up 50 or even 100 tabs at once. And then I spend, 20 to 30 seconds kind of skimming their profile. A lot of times they will talk about what kind of deals they do. Like Karen here does vertical agnostic, consumer SaaS. Okay, we're SaaS. FounderSui is SaaS, so that looks good. And a lot of times people will talk about either their portfolio, what they're investing in, or what they're looking for. Karen looks good, so my next step would be to click this mutual connection and see who my strongest mutual connection to Karen is. I know Jonathan, okay. I know Juan, okay. So let's say I might just pick Jonathan as my mutual connection. Back in my target list of investors or my CRM, I would mark down Jonathan as the person who I'm going to be asking for that introduction. And then Command W, close that out. Look at Carl, angel investor, M&A. Nothing really jumps out at me. Wireless industry and telecom, we're obviously not doing that. Nothing really jumps out at me that he does my type of deal. I don't see fintech. I don't see SaaS. Probably just going to Command W and close that. And, just kind of repeating this process. You can go through a fairly large list of potential angels pretty quickly. One more thing here. I don't see anything jumping out here. This guy sounds like really more into M&A, probably does a little bit of investing on the side. I might click through to Aziz Ventures and see what kind of deals they do, but I think you get the process. So that's one way to tap your personal network to be building that target list. I'm going to show you one other thing I did that was actually pretty effective. So this is my investor pipeline I've been building. And this is a demo account, but the point remains, I created a column. So this is the pipeline I'm building of investor prospects, right? I created a column. I called it Steve B Leads. And then I invited a guy named Steve Bennett. He's a real person into my account. He's a professor of finance at San Jose State and an advisor of mine. And I said, hey, Steve, I'm building out my pipeline. I've made you a column. Can you populate this column in my CRM with some people you'd be willing to introduce me to? And he did, and he populated it with like 10 or 15 names. And I repeated this process with 5 or 6 other advisors, and I generated about 50 or 60 really good, strong, warm intros by having a structured way of asking people to open up their network, right? I didn't just call up Steve and say, hey, Steve, I'm raising money. Know anyone? I had a structured way for him to actually like open up his network. So that was pretty effective. All right, I'm going to keep moving here just because we only have about 10 more minutes. Once we've built that list of investors, we actually want to start removing people off this list. Anyone who's invested in a competitor, cross them off. Don't even send your pitch deck to them. If they're ethical, they won't want to talk to you. If they're unethical, they might send your pitch deck to your competitor. If a venture fund hasn't raised a new fund in the last couple of years, they're probably only doing follow-on deals to their existing portfolio companies. So, you might still meet with them just to get a little practice in your pitch, but it's easy to waste time pitching venture funds that don't really have fresh capital to put to work. Same with angel investors. If you look at their portfolio and all their deals are from 4 or 5 years ago, they might be taking a break. Wrong sector, wrong stage, wrong geographic location. That should be pretty obvious. If you're fintech, you would not be pitching a medical devices investor. Wrong geographic location. Some investors are specific in what areas they invest in, others less so. And I think we're seeing a trend with COVID and virtual pitching that investors are a lot less focused on where you're based, which is, pretty good for many startups. And then bad reputation. There's a kind of a joke that the average VC relationship lasts longer than a marriage, except in this relationship you're about to enter with your investors, you can get fired by your investors if they have control of your board. So you want to be picking investors, obviously have a good reputation, tapping networks such as Nasdaq Entrepreneurial Center and your personal network and doing diligence on investors, checking with founders they've invested in the past is the best way to kind of screen for that. As a general rule of thumb, we want to be removing about 25 to 30% of that target list so that what remains is a really highly focused list of relevant targets. So much of about fundraising is about getting momentum going for your deal. And it's very hard to get momentum going for your deal if you're pitching poorly qualified targets. So the more time you put into researching, qualifying your target list, scrubbing your list, the better your fundraising is going to go. Next step, I'm going to move really quickly through this, but the next step is to really try and map your best connection path to every target on your list. A lot of this is done in LinkedIn to see if you have any mutual connections. If you have 0 mutual connections to a target investor who's perfect for you, the funding hack here is to reach out to 2 or 3 portfolio company founders that Tim has invested in. Cold email to these founders saying, hey, I see Tim, love to hear what it's like working with him. Is he helpful? Is he active? Is he more passive? You get a rapport going with that portfolio company founder that, maybe have a Zoom meeting or virtual coffee or whatever with them. Then it's okay, if you feel comfortable to ask them for that introduction to Tim. And the reason this hack works really well is that founder was doing exactly what you're doing 6 months ago. hustling and networking their way into introductions. And there's usually, founders are pretty good about helping other founders. On the flip side of the coin, Tim spent, X number of months getting to know that founder, going through diligence with that founder. So there's a strong level of trust. So it's a really good way to get that intro. If you're not willing to kind of hustle like that, there's always the cold email. I think hopefully he wouldn't get mad at me, but I think his email is like tim@dfj. The problem is these guys and gals are getting 50 to 100 warm intros a day. So your cold email, if it's even, read, is often going to have a stigma attached to it already. I was on a presentation with Jeff Clavier, who I think is from Uncork Capital, and they were talking about cold email. He said they've invested in 2 companies that came by via cold email out of about 700 portfolio companies. So while it's not impossible to get, do the cold email approach, your odds are almost statistically impossible, close to it. So once we'd built this list of 200 or 300, qualified and filtered it down, mapped our connection paths, we want some way of organizing all the discussions you're about to have. I used to build these beautiful spreadsheets for founders, which would work great for the first week or two, then they often get really messy. I promise I won't do a long product placement, but that's the reason we built foundersui. We built it as a purpose-built CRM for managing an investor pipeline. And whether you use foundersui or use something else, I strongly encourage you to have something, some system to track all these discussions you're about to have. You're going to have 200, you're going to be meeting with 200 investors. Every time you have a meeting with them, there's going to be a 2 or 3 follow-up activities that have to happen. You need some way of staying on top of this. The yellow sticky notes and notepads aren't going to cut it. And back to that thing I mentioned about momentum, fundraising is driven by momentum and tempo, speed, the rate at which your deal is kind of happening and evolving. And it's very hard to get speed going on your deal if things are slipping through the cracks, if you're running a sloppy process. So you want some way of really keeping organized and keeping everything on track so that when you're in diligence, you're responding, you're impressing the investors by how fast you're responding with things, right? So there's the pitch for using a system. Hopefully you'll give foundersui a look. Not even going to cover this because I only have about 5 minutes left, but make sure your pitch is amazing before you go out fundraising. Probably the biggest reason I see founders fail is they go out fundraising with a crappy, confusing, too dense pitch deck. And you don't get a redo. You don't get a do-over in 2 months. So make sure you practice your pitch with fellow founders, your advisors, your mentors, even your attorney, so that you're going out with a really strong pitch. And it's great if you have a financial forecast as well. I'm going to skip over this, but this is an intro, an email, intro request email that if you find some of your connectors have multiple connections, this is what you could send them saying, hey, are you willing to introduce me to these people that I see you're connected to? If they say, sure, I'm happy to introduce you to a couple people. This is an example of the intro request email. Just a few things to point out here. Notice how short this is. Another mistake I see founders making is this intro email to investors is, has a 45 megabyte PowerPoint attached to it, an embedded video, and like 6 dense paragraphs of, the whole history of that company. That's a fail right there. Investors don't want to read, they won't read it, and they won't read your email. And so it won't go anywhere. So shorter is better. Couple key points. The subject line is super important. Whatever is the most exciting, sexy part about your business, put it in the subject line here as a lure for them to open it. Notice a real short, Jeff, good chatting with you. I'm raising a seed round. This is what we do. We make this investor management platform. Here's a link to our site. Then the ask, second line, could you introduce me to target investor? And then I personalize this a little bit with because the guy went to the same small college in Iowa my dad went to, so I put that in there. And then I include a link to our deck. And this is not our full deck. This is a teaser deck. It's like 5 slides. It's like problem, solution, market, team, and traction, right? Like 5 slides. Is that 5? Problem, solution, market, team, and traction. And then when my connector forwards this along to the investor, that investor, can look at what we're doing, look at our stage, look at our traction level. And if we're not a good fit, I'd rather have him opt out in advance. So it's another way of qualifying that investor. If he does want to have a meeting, then I can go back and look at the analytics because I'm tracking, of course, his views, and I can see how much time he spent looking at my deck. Did he even look at it? And then I can tailor our pitch accordingly. All right, 3 minutes left. If you haven't watched HBO's Silicon Valley season 1, go watch it. It's hilarious. And it's just so funny. Richard is the CEO of Pied Piper. He's an introvert. He just is an engineer, wants to be writing compression algorithms, but he's got to get out and hustle with all these investors. 40% of VCs went to Stanford or Harvard. Lots of big egos in the investor world. And investing is what they do all day long, every day of their lives. For Richard, it's his first time. So the only real way to counteract that is to, as I call it, channel your inner hustler and kind of make it like a game and have fun with it and a learning opportunity. All right, this is the last slide I'll go through, but a couple hustle tips here. Doing the intros in parallel, that means asking your connectors for those intros all around the same time frame. What we're trying to do is this blitzkrieg approach. We're trying to get momentum going for your deal. Every investor you meet with will ask you, so how's the round coming together? And you want to be able to answer that with something like, it's good. We just kicked off our raise. I've got 10 meetings this week. I've got 14 set up for next week. We're running a pretty efficient process using foundersui, of course, and we're aiming to close this out by Thanksgiving. That's signaling to that investor you're talking to that others are interested. You have a process in place. You're running a real process here. And that if they're even remotely interested, they need to kind of march along to your game plan, because investors will watch and wait if they don't have a catalyst, if there's no FOMO involved. You should always be improving your pitch. Bring a co-founder along with you or having them sit on Zoom meetings and just write down every question that is asked, and then go back that night and build an appendix slide for those questions. So your deck is getting better and better. Leveraging pieces off each other, that's just signaling without exaggerating or lying that others are interested. As you progress beyond just pitch meetings, getting into diligence or even term sheets, you want to be able to communicate that, to other investors. Last but not least, maybe my favorite funding hack of all is start sending an investor update or company update. I'm just going to show you an example of what that looks like. Start sending a company update to your prospect list 6 to even 12 months in advance of fundraising. And what you want to do is reach out to that, if you follow along, you've built a list of a couple hundred investors. You want to reach out to those investors with an email saying, hey, I've identified you. I've been following you on Twitter for a while. I run XYZ company. We make XYZ. We're not raising money right now, but we are going to be raising in Q2 of 2021. We do a one-page company update once a month, very lightweight. May I have your permission to add you to our distribution list? So you can have an early peek of what we're building. So it's that you send them, each of those investors, that permission email, and then you start to send them a company update. And let me just show you what this sort of, can look like, and then we'll conclude here. But this company update is really short and simple. Look how short this is. Short. A little overview about what your company does. Just as a reminder, keep this in every update. A little bit about what progress or key wins you made, last month. Include your key metrics, whatever that is for your company. And then tease them about what's coming up this next month, what you're going to be working on. And then include, a link to, or not a link, include images of your team and possibly even your product, if your product is photogenic. What you're doing 6 months before fundraising is you're connecting the dots with these investors between what you're doing, the progress you're making, the big vision, and who you are, right? And you're nurturing these relationships so that, 5 months In month number 5, a month out before you're actually raising, you actually drop in one of these updates. Hey, we're going to kick off our funding round next month. Please let me know if you're interested. And this whole time you can be tracking who's reading your updates and how much time they're spending. So if you're sending this to 200 investors and 100 of them are opening up your company update and 25 of them are reading it, 5 minutes, those are the ones that are probably going to be the ones that write the checks eventually. All right, I want to conclude it there. Last point I'll make on this, and then I'm super excited for this fireside chat. The more you can treat this like a full-time job, you know, while you're actually fundraising, the faster it's going to go. What another common mistake I see is founders kind of part-time their fundraising. It drags out, never catches momentum, and gets kind of stale. And last but not least, it's really stressful. I actually thought I was getting an ulcer in the middle of my fundraising, and I had been fundraising for 12 plus years before that. That's common. No, that's what you're getting into. You're going to get rejected 95% of the time. That's just the way it goes. So I think we have questions at the end. I know this is a ton of content thrown at you. But unless there's any further ado, I'm hoping he's online. I'd love to introduce my friend Gautam Tambay, CEO of Springboard. Gautam, can we hear and see you?
I can hear you and see you. I don't know about if it's working the other way.
Brilliant. Yes.
All right.
Hello. How are you?
Hey, good. Good to see you.
Good to see you. So we met years ago. I don't even remember where, but we recently did a podcast for the How I Raised It podcast, which was one of our more popular ones. Super excited to have you here. How's your day going so far?
Can't complain. I am working on 2021 strategy, so just trying to take some time away from the team to lock myself up and figure that out. So far so good.
Awesome. So for folks online, what is Springboard? Let's start with what you guys do.
Yeah, we are an online school that helps people get into new careers in tech through intensive online mentor-guided programs that come with a job guarantee. If you don't get a job within a certain amount of time of graduation, we refund your entire tuition.
What are the most common or popular jobs that people are training for on your platform?
Yeah, we focus on the skills gap where the demand for talent is much more than the supply. So today we have people learning data science, machine learning, UI, UX design, software engineering. We're looking at additional areas like cybersecurity, sales. There's a big gap there. So yeah, really wherever there is more demand for talent than supply, which is a lot of places because the economy has completely changed in the last couple of decades, but especially so in the last 9 months.
Maybe I'm sure it'll change multiple times, but my kids, what direction should I be pointing them in? I'm sure it'll change by the time they're actually ready to go to the job market, but what would you advise?
Yeah. Well, it depends on how old they are.
They're young. They're still in elementary school, so way
yeah. I think that the job that they will have when they are 25 doesn't even exist yet.
Yeah, right.
So right. I would, but here's what I would say, right? I think it's going to be a very legitimate choice if you have. I have a 8-month-old, and I think that for him it's going to be a very legitimate choice at 17 to have a conversation about, hey, one option to for me is college, and then there are these other options and other alternatives that are non-college alternatives to having an equally successful white-collar career, which if you think about when I was going to college, that didn't really exist. And even today, I think that's not really a thing. So I think it'll become college will become optional. It'll still remain a pretty mainstream pathway for a lot of people, but it won't be the only option available to have a great career. So that's what I'll give you for your kids. So don't be surprised when they come back and want to have that conversation with you and say, hey, all that money you've been putting away for college, we may not, we may want to use it for something else.
I would love that. If you could hook me up with a discount on Springboard 10 years from now, and I can use that money to buy a boat or go sailing or something, it's a win-win, I think, right?
Well, Springboard is like 10% of the price of college, or less than that, actually, maybe like 5%. So you're already getting a 95% discount on college.
Awesome. Cool. Well, so you guys just fairly recently, completed your Series B round, correct?
Yeah.
And tell us what were the details on that? How much and who led it?
Yeah, so we started raising right around when the pandemic hit. I think March 30th was when I started fundraising, and it was planned. It wasn't a response to the pandemic. In fact, we debated if we should continue doing it or not, and we decided we're just going to go ahead and do it because our metrics were very strong at the time. And we raised $31 million. It took us about the process. I ran a very tight process. I heard you talking about process earlier. End to end, it was 5 weeks from first pitch to term sheet. I think maybe a little less, actually. I think the first pitch was made March 30th. I had my first term sheet before the end of April. So maybe 4 weeks from first pitch to first term sheet. And then, of course, like filling up the round took another 3 or 4 weeks. And so by June, we had closed.
That is truly amazing, given that you kicked it off. You said March 30th. I mean, that was like the peak of, I forget which week the Nasdaq crashed. 2 weeks that Nasdaq crashed, right? But it's right around that time frame.
People were scared.
Uh-huh.
Investors were scared, and you could see it. It was interesting, and I think nobody knew what was going on. And that was part of the reason why we decided to raise at the time. We knew that we would take a bit of a hit on the valuation was because people were scared, and I think everyone was adjusting to the new stock market, which at the time was actually not looking good.
Yeah.
But for us, we said at the time, in hindsight, of course, maybe we should have waited another 6 months and got another 20% bump on valuation. But the reality is, at the time, nobody knew what was happening.
Did you need to raise then? Like, was it one of these, like, I've got to raise now, we're going to be out of money? Or was it, yeah?
Yeah, we needed to raise in 2020.
Yeah.
Right. And so it wasn't like if we don't raise next month, we're going to be out of money. We had some buffer there. The problem was we actually didn't know, like, I don't know if you remember what March 30th felt like. We had no idea what 2020 was going to look like economically. Right. And,
Sure.
and I was around last recession, and I think there was about a year or 18-month long period where really money just froze up. That hasn't happened, but we only know that in hindsight.
Yeah, of course. So one of the things we talked about when we did the podcast is that you would, given that context, March 30th, people are panicking in some cases. Other investors are just going hard on their existing portfolio companies, triaging their existing companies. Something you mentioned is you would qualify investors that they're actually doing active deals. Talk about that. How did you actually figure out who's going to be doing a deal in this crazy new environment and who isn't?
Yeah. And this is something I would encourage all entrepreneurs to always do, because there's a lot of people who will take meetings, and your time as an entrepreneur is really, really precious and valuable. And it's one of the biggest mistakes that people make. And I made that mistake early on, is I didn't value my time enough, especially when you're really early stage, not even paying yourself. You don't even know what to value your time at. And I tell people now is, once you're kind of past the very, very early stages, like put a really high value on your own time, value your time at like $1,000 an hour or more. And that sounds crazy, but that's really that's the opportunity cost of your time to the company. So where I was going with this is, so how do we qualify? We actually, everyone, we were asking this question to people, which was, hey, is your firm open for business right now, right? And everyone said yes. So we realized that wasn't actually a qualifying question, because nobody, you want a qualifying question where people actually drop out. So we changed that question to say, have you actually issued a term sheet to someone since the pandemic hit? And then we saw a lot of people dropped out, because they'd say, no, we haven't yet, but no, really, we're open for business. And you sort of kind of suss that out. And the second question we'd ask is, okay, you've issued a term sheet. Has it been to somebody you met after the pandemic, only remotely or not? Yep. And I think these two specific things matter less now, because I think everybody is investing in people that they have only met remotely. Everyone's gotten comfortable with it. But I think the broader point is think about actual past behavior as a way to qualify people, rather than like what they say about the future. And I think that's true, not just in fundraising. I also use that as a technique in interviewing candidates for jobs at Springboard, right? Like use past performance. Everyone's going to say they'll do the right things, but did they actually do it when they had the opportunity to in the past?
Yeah, interesting. One of the other things that I thought was so interesting during our previous chat is this concept of searching for believers, right? Do you want to just go into that and what you kind of mean by that?
For
I think it's a
sure.
great concept. So
Yeah, for sure. Actually, do we know if the audience is what stage people are at? Is it like early stage founders or
it's a mix, a lot of early
Yeah.
stage. I did look at the spreadsheet. It's pretty pretty skewed, but yeah, I think we're going to see
that's helpful because some of the tactical advice I'd give actually varies by stage.
Yep.
To this question. So one of the things I learned early on during fundraising, and of course, you were talking about rejection, right? Like 95% of the times you got rejected, and that's just part of the process. And that can be really hard. And one thing that made it much easier for me, and it has continued to make it easier for me, is a piece of advice I got early on from one of my founder friends. And he said, don't think of the fundraising as an exercise to convince investors that you are right for them. Think about it as an exercise to find the people who already believe. So it's a search. It's not a debate or a convincing exercise. And that really, really put things into perspective for me. It was super helpful. And that did a couple of things. One, it let me put rejection into perspective, right? And let me focus and go deeper on people where there was some belief, which was great. And I think the other thing there is a couple of things. So now that shouldn't become an excuse to not take the feedback from people who don't believe. But I think that's still really valuable, right? So it's not, like, the idea is not to dismiss people who don't believe. The idea is to say, well, you don't believe today. Let me learn about why you don't believe and get some understanding of what would make you believe. Just write that down and move on, right? Don't dwell on that.
Yeah.
And I think that's also helpful because somebody who is not a believer today might just need to see some more data points from you to believe, or they might need to see, investors like to invest in lines, not dots. And so when you go back to them, when you're raising your next round, that might change. And every single round, pretty much we've raised, and we've raised from the start of our journey, maybe like 5 or 6 rounds at this point. Every single round has had somebody invest that had said no before.
That's amazing. And with those, especially with those folks, how would you keep them engaged? Was it a newsletter? Was it just socializing the next deal, as that thing was coming up, or what?
Yeah. I think it really depends on what is authentic to you as a founder. I think newsletters are a powerful technique. It's just not my jam. Like I wouldn't, that's not how I communicate with people. And so I would encourage you to do that if that feels right to you. For me, I would find ways to organically stay. I would sort of keep track of people who I really like. Actually, I don't use a tool like FounderSuite. I was using just a Google spreadsheet, but one of my columns is this person, was I impressed by them, and do I want to stay in touch with them?
Mm-hmm.
And with those people, I would usually give them a heads up. I usually try and meet them every 6 months, right? And just have a conversation, because one of my challenges with the newsletter is it's one-way communication, right? And I also want to understand and learn about the investor and assess them. Do I want them on my cap table?
Sure. Yep.
So I personally prefer the fewer people and just like having every 6 months meeting them for coffee when you're not raising, because when you're not raising and you meet them, the power dynamic is different. It's a meeting of equals, right? You're not there with your hat in your hand and asking for money. And
let's talk about that a little bit more. So, really getting into the weeds on that, are you simply just calling up like, hey, we're not raising now, but I just have a strategic issue I'd love to run by you, or like you're asking for their time. Their time is valuable. So how would you kind of get them to,
Yeah. So this is specifically about people, for people where I met them, we had a good connection, and there was something that was worked in that meeting, but they were just not ready to invest in it, right?
Yep.
And so I think at that point, I would just say, hey, would you like to, we're not raising, but it would be good for us to give you an update on what's happening in the company and learn how things are evolving and how things are evolving at your end. Yep. Like what's changed, what have you invested in, what theses are you prioritizing? So it's a two-way exchange of information. This is not me giving you an update. This is us catching up and me learning about how you're thinking about the world as much as you're learning about what's happening in our business.
That's great. That makes sense. Very cool. You did a few interesting things here. I think we've got about 5 minutes and then we'll open up for Q&A, but you did some interesting things with your actual virtual pitch calls. Tell us what you did and how you modified your pitch in the virtual world.
Yeah, that is something we changed. We realized when we first started pitching on Zoom and did a couple of practice pitches with our existing investors, we realized that it's really hard to create the same energy in a room as you can when you actually walk into somebody's office or they come into your office. And so we realized that one of the ways to create energy was to actually have a lot more activity on the slides, right? So more animation, more slides changing quickly. So as an example, normally you would have like a 10 or 12 slide investor deck, right? Like that's sort of best practice. We ended up adding more slides to it, and just things were changing more rapidly, and it was more of a rapid fire thing. But also we added this, believe it or not, 40-page student journey slide loop. But I go through it in like 5 or 6 minutes, right? Wow. So it's really, really quick. In fact, what I might do is I might pull up like I might actually see if I can pull it up and show 5 slides of that. But that really kept people engaged, and also really interestingly, like I was like, it made me realize we should have been doing this all along. People really got to see what the product looks like. So yeah, and that was very, very engaging for people. And just the fact that it was fast-paced and changing, and there was something happening other than just like a talking head.
That's really interesting. Well, if you would show that a few slides, that would be really interesting. I've heard that from a few VCs I've talked to. I had a conversation with a VC last week, and he was like, it's so hard pitching. He gets it, that it's hard to pitch over Zoom. It's hard to still have that personal connection over Zoom for founders. His thing was like, founders need to dial up their energy, to 11. He's like, have some Red Bull, take 5 shots of energy before the call, whatever it is, so that when you're on the Zoom, it's like an extra level of energy, because investors are just like Zoom fatigued and everything else. So
yeah, I think there's some merit to that. Like I think, again, do what's authentic to you, right? Yep. And bring energy in the way that's authentic to you, right? I think that for me, I'm already a pretty energetic and animated person, so I didn't feel the need to have an extra shot of Red Bull or whatever. But what I would do is I would sort of walk out on my deck, and I had, my EA had scheduled meetings for me so that I would always have like half-an-hour breaks between consecutive meetings. I had like 5 or 6 meetings a day, back to back for a couple of weeks, right? And I would just step out on my deck, breathe, just like breathe in and be centered. And I think if I'm centered, I bring a good energy to the meeting. So it's not, I don't think it's about, think about what you need to bring to be, to capture attention, to be memorable, and to be effective. And I think, again, big thing is I think the most important thing is be authentic to who you are as a founder. If you're not, it's going to be hard for you, and it'll come through.
That's interesting, though. Just let me touch on what you said 20 seconds ago to put this in sort of what people should expect to do. If you want to raise money, $31 million during a pandemic, you're having 5 to 6 meetings a day over Zoom, half-hour break in between each one to just kind of reset, recharge. But that was your pace for a couple months, 5 weeks, I think you said, something like that?
Yeah, so you've got to run a tight process, right? So what you want to do is you want to do it's a funnel. I mean, I think you showed a funnel earlier. You want to do all your first meetings in 1.5 to 2 weeks, right? And you really want to pack your meetings back to back. If you have the ability to have somebody help schedule those meetings, that's great. Of course, like until our Series A, we didn't have that, so I was scheduling them myself. But what you want is, and one of the nice things about this environment is you're not driving around on Sandal Road. So you can actually schedule them really at your convenience, and people are also more flexible. So I would say, so you're on all your first pitches in the first 1 to 2 weeks. I can do 4 meetings a day pretty effectively. I can do 5. 6 is a stretch. Like I'm talking about specifically VC pitches because they're an hour each. I always like to have at least a half-hour break between the two. You need to process what just happened.
Yeah.
And you need to, again, like for me, I like to be centered going into the next one. So and just make sure you have enough breaks to actually, like, again, manage your energy, right? Like, don't be hungry at 5 p.m. because you haven't had lunch and now you're pitching somebody when you're tired. So do that. And then once you've done with all your first meetings or first pitches, then some of those will convert into second meetings, and some of those will convert into third meetings, and so on. So then the calendar continues to, I think the cadence is still similar, but what's happening is I'm having higher and higher fidelity meetings. So in week 3, I still probably have like 12 or 15 meetings, but it might be 12 or 15 meetings with only 8 funds who I'm meeting twice each in that week. Right. Whereas in the first week and a half, I pitched like 40 funds top of the funnel.
Fascinating. Do you have a couple slides you can show?
Yes. Let me do that. Yep. So I'll go through this super quick. I won't actually voice it over. It's more to give people a sense for what we did. So this was kind of a loop we went into we had our main fundraising pitch deck, but then this was like a side loop, and sort of like, it's like, hey, this is what the curriculum looks like. This is what we do, industry projects. But then really, we talk about this one student's journey who was looking to become a data scientist. She tried a couple of things, didn't quite work for her, stumbled upon Springboard through Google, applied to our career track. Once you apply, immediately you get a call from one of our salespeople. By the way, on the back end, we are tracking every single sales call on these 21 metrics. Guess what? There's a skills assessment. She passed it, and so on and so forth. Right? And really, like sort of it goes on like that. And then the story really talks about the whole experience that she went through. And then, of course, the nice thing about it is it ends in her getting a job with a Springboard alum who hired her. So it's a very positive and uplifting story. So I think 2 things about it were effective. One was just really understanding the student journey, and it's literally like, it's 40 slides. Yeah. Right. But I go through the whole thing in about 5 minutes. But so 2 things are powerful. One is the fast pace and just the energy. And I go through it a little bit slower than I did with you all right now. But the second is it's an uplifting, positive story. And guess what everybody can use right now in this time? Awesome. An uplifting, positive story.
On that uplifting note, I think, Maria, do we have some questions from the audience?
Yes, we have lots of questions. So Nathan and Gautam, thank you so much for sharing your wisdom. For everyone here that is listening in, please submit your questions in the Q&A function and/or the chat function. I would be happy to voice those to these 2 experts. And we actually have quite a few questions already submitted. So if you both are ready, let's dive in.
Yeah.
Wonderful. So, and I'm also merging a few questions. So it's very clear here to me, a number of questions are very specific to different raising rounds and the types of rounds. So I will, let's say, bucket these questions into what does each raising round look like? And maybe Gautam, maybe you can speak to what were some of the previous raising rounds that you had done. So we have questions about crowdsourcing, crowdfunding, maybe a seed round. What could those rounds look like for these earlier stage founders? And how might they move through those rounds, if you have any advice around that?
Sorry, I'm just trying to make sure I understand the question. So there's a lot packed in there. So I'm trying to unpack, like, what is the actual question? Is it how should founders think about going through early stage fundraising and rounds? Is that the...
Exactly. So what are the different rounds of raising and what do they look like? What are the distinctions and what can founders learn specifically from your journey, depending on the rounds that you've been through?
Yeah, I think the distinctions are becoming less clear now than they were maybe like some years ago, right? Like, what is a seed round and what is a Series A? And like, people are raising 6 million seeds and 5 million Series A. So like, where is really the distinction? I think that one thing that was helpful for me, especially since there are a lot of early stage folks here, is at least up until your Series A, you can think about your fundraise as as a continuous process rather than a discrete process. So one thing we did that worked well for us early on is we raised our seed round, which is really like 4 different rounds at different safe notes at different valuation caps over a period of 2.5 years, right? So we did a first safe note at the $4 million cap, and then our last safe note was at a $20 million cap, and we had 2 others in between. And in those 4 tranches, we raised a total of 3.7 million over, I think, 2.5 or 3 years, over like 4 different tranches. And so that's one way to think about it, is that until you're raising institutional money from, like a Series A investor who will want to take 20% of your company, you don't have to think about fundraising as discrete.
And I'll have a few thoughts on that too. I think, as Gautam's saying, the format of the rounds changes over time. You might start off doing a safe or convertible note, and then get into priced rounds, meaning equity rounds, and then eventually possibly even venture debt. I'd say the number of investors you're talking to changes at each round. In the early days, oftentimes it's larger numbers of, angels and friends and family and everything else. As you get into later rounds, that funnel size contracts a little bit. I would say also, and Gautam, I'd like your input on this too, but in the early days, it's about vision and team. In the later rounds, it's more metrics, right? Just numbers driven. What are your metrics? How are they trending? And it's less vision, more numbers. So
absolutely. I think the way I think about it is that vision and story are table stakes, right? And vision, story, and team are table stakes. So you'll always need that. The thing is, in a seed round, that's all you have, and so that's sufficient. At a Series A, people will want to see some proof points of that story coming to light. Maybe it's like, hey, you have really some qualitative feedback. Maybe you've got some really good reviews from customers, and you're starting to see the numbers trend in the right direction. By the time you're raising a Series B, it's really all numbers. Now, that doesn't mean that story and vision doesn't matter. That is your ticket to play. That's what gets you in the door. But then it's much more about metrics and numbers.
Thank you both. And I think a great follow-up question here would be, what is the importance of data? And if you don't have data points as an early stage company, what might you include in the pitch deck? And Gautam, I feel like you hit on this a little bit with the journey that you just shared with us as a case study.
Yeah, I think that, okay, so generally speaking, at least in the early stage, right? When you're really early, it's unlikely that investors are going to be inspired by our data. They might use data as an additional data point to believe, but the inspiration is going to come from the story and the vision. And at the end of the day, think about and this is especially true at seed and angel rounds, right? You want to give somebody a reason to be excited and talk about you at a cocktail party and say, hey, I invested in this great company. This is, let me tell you what they're doing. It's so exciting. And let me tell you the future they're building, right? Especially at the angel round or the seed round, where people are investing their personal capital in you. That's really what you want to get them psyched about. And then the data needs to support your story, right? Because there's not going to be a lot of data anyway at the seed and angel stages. So I would then give them, if you don't have data internally, I think what matters is a couple of things, right? If I look at a seed stage investment, I think what matters to me is there a vision, compelling vision and story of how this becomes really big? Does a founder have a dream? But then the second thing that really matters is, have they done something and put something and tried something and iterated and tested, and have they demonstrated grit, right? And what is that seeing in the market? And finally, maybe some data on how big this market is, how others have cracked it, which demonstrates to me what the market is big, but you have the ability to actually think laterally and say, I can think about what's happening in this market, apply it to my market, and build a compelling argument. That's at the early stage. I think it's different at later stages.
Thank you so much for sharing. I know we have a lot of very early stage founders on with us, so these questions I know are helping them. We have some great feedback in it.
Yeah, and I have a lot of empathy for early stage. We've all been there, and it is the hardest part of the journey. So more power to you guys and girls.
I'll add one little bit to that. If investors are expecting or asking for data that just aren't going to have at those early stages, they might not be the right investor for you, right? There's different levels of expectations. I think back to our seed round, we didn't know our CAC, our cost of customer acquisition. We didn't know our lifetime value. We just didn't have enough data to be able to calculate those things in a realistic way. The data I did have in my pitch deck was like how many people are signing up and how that's changed over a period of a month or last few months, right? We didn't even have good metrics on like churn because we weren't even monetizing at the beginning, but I still had proof that people were interested in what were building, right? And that was at least something to hang a hat on. So.
Yeah, totally. Yeah, no, I agree with that.
Thank you both. Let's see. So we have some additional questions, maybe more tactical. Hold on one moment.
I think tactical questions are great. I think often it's like, that's what I wanted when I was an early stage founder. I was like, don't spare me all the grandstanding. Just tell me what I should do.
Right.
Amazing. Well, I have one here if you're ready for it.
Yeah.
What are the advantages and disadvantages of using a safe structure for a seed round?
Yeah, I think that's a great question. And I think that the biggest, so again, I'll tell you the context I'm coming from. We did all of our seed fundraising on safe notes. The big advantage is that you can make fundraising a quick, efficient, and what I'd call somewhat continuous process, because you can, you don't have to say, I'm raising X million dollars, I have to raise this much. If I'm raising $1 million, if I get 4 people to commit 100K each, it's 400K. I can get that in the bank, keep making progress in my company, and then, figure out a way to raise the other 600K later. That's one. It's just a really simple, it also removes a lot of the legal back and forth. It just keeps it really simple and clear. That's the last thing you want to deal with as an early stage founder, is to spend a bunch of money on lawyers to figure out your round. Disadvantages, I think one is that not all, there will be some investors, some earlier stage institutional investors who will say, we don't do safe notes, we only do priced rounds, and that's fine. I think what I would say is, hey, we're doing a safe note, but if somebody wants to lead the round with a big check, we're open to a priced round, right? So don't close the door on that. And most people in the Valley, at least, are now comfortable with safe notes and don't really care. The second disadvantage of safe notes, which I think is not that big, but people should be aware, is when you are converting safes into equity, which usually happens when you raise your first price round. After that, it can be a little complicated, and it can be a little bit surprising, the dilution, depending on how your caps and your discounts were structured. But in my mind, if you're getting to that point, that's a good problem to have. Like if you're raising a Series A, like this is not going to be the biggest problem you have. It's just something to be aware of. Like I personally wouldn't worry too much about it.
Thank you. Nathan, did you want to share any thoughts?
I don't have too much to add. I think, I think there is some risk if you're stacking lots and lots of safes on top of each other. You hear that has come back to bite people a little bit. I think, as Gautam mentioned, like we started out doing a 500K convertible note, and then when we found an investor who wanted to do a priced round, we threw away the note and switched to a price round. So, there's some flexibility here. It doesn't mean you're married to any one form here. So
I think that's key. Flexibility in fundraising is key. Afford yourself the flexibility, and don't feel like you have to hit a specific fundraising number or metric or valuation. At the end of the day, it's capital that helps you get to your next stage, and this is all in service of achieving your broader vision and dream for your company. And this is just fundraising is a means to an end. It's not the end in itself.
Good quote right there. Yep.
Yeah. And that's, by the way, another thing. Like every time we raise a round, we go back. Yes, we celebrate with the team. The first thing we tell the team is this. It's like, I think the quote I really liked on this is the chef doesn't celebrate when they buy the ingredients.
Interesting.
And that's fundraising, right? You've just bought the ingredients.
Yeah. Never heard that before. I like that.
There's one question that I can take quickly here, which was, what do you do when a VC asks for a slide deck without offering a meeting? Pet peeve. I hate when that happens, but it'll happen. And I understand the other side of it, which is sometimes they're just like, hey, is this really worth, spending my time on? My hack for that is I always have a 5-slide teaser deck and really pull out the 4 things that are most impressive about your company. So for example, one of our rounds, our growth was just off the charts. So I just put that out there, and I think I redacted the actual numbers. I just sort of showed the shape of the curve, and then like how the product works, right? And I said, listen, we're happy to share a teaser deck before we meet, 4 slides, and would love to tell you more about the story and where we are going. We'll prefer doing that in person.
Thank you for jumping in there. We have another question from Sophie. Sophie, thank you so much for submitting. So if an early stage founder is not up on the key technical terms to perhaps keep a conversation going with investors, or they're looking to learn more about understanding valuation, how might they do this? And what are some books or resources that you might recommend?
Yeah, that's a good question. I think that, and I'm sure, Nathan, you have a few as well. What I've found helpful is a few blogs. I think Mark Suster's blog, Both Sides of the Table, is really helpful. I think that Fred Wilson's blog, avc.com, is helpful, though often deals with sort of later stage stuff. And then I found, was it Venture Hacks, which was like Naval and Nivi's blog?
Mm-hmm. Need a PDF too. Venture
yeah,
PDF
yeah, that's helpful. Big. That's helpful as well. And I think the other thing I would say is, talk to, at least for me, what I found is, yes, I can read a lot and that's helpful. But also just have a couple of like 2 or 3 founders in your network who are maybe a year ahead of you, and build that network for yourself anyway. It's really valuable because one of the great things about entrepreneurs generally is, I can never pay back what I got from people who gave me advice, but I can always pay it forward. And I think there's generally a culture of paying it forward among people. And just have those couple of people you can just quickly call and say, hey, I'm struggling with this. And I still have that, right? Like, it's like we're now a 200-person company, and there's many parts of my job that I have no idea how to do anymore. And I'm calling people who are 500 people and saying, hey, how do you do this thing? Or have you seen this thing? And that'll often shortcut your learning.
And I'd add to that, I think obviously you're in the right place with Nasdaq Entrepreneurial Center, right? Little plug, ding ding for the center here. I think they're joining an accelerator or applying to an accelerator. Obviously you'll learn a ton and have those mentors that Gautam talks about. There's a book called Venture Deals, Brad Feld and Jason Mendelson, I think is pretty good. And then there's an older book that's probably 15 years old. I think it's just called VC Term Sheets or something very generic in the title, but it's a real thin book, probably on Amazon. It goes line by line at each term, and it presents a founder favorable version of it and an investor favorable version of it, and kind of the neutral. Easy read, plain English, but I would look at that if you're really looking to get into the terms. But you need an attorney too. I would, plug the sponsors here, because I wouldn't complete a financing round without having an attorney involved. There's my disclaimer. So,
thank you both. Absolutely. So I love the plug for Nasdaq Entrepreneurial Center. We do have programs like this that actually help early stage founders understand the terminology and what early stage moves that you can make. So we'll make sure to send that in the resource email. And for everyone still listening, we actually would love to hear from you. We have a few more minutes together. Please fill out the survey that Olivia, our production person, has put in the chat. Nathan, Gautam, and Nasdaq Entrepreneurial Center would love to hear from you. We would love to know what you thought about this session, and also we would love to put on additional sessions similar to this. So let us know your thoughts. It looks like we have time for 1 or 2 more questions. We have quite a few questions, I would say, about valuation. So can you provide any guidance on establishing valuation? Is there a way to come to this collaboratively with the VC, or does the founder do this 100% and need to enter the conversation with valuation in mind?
Yeah, that's a great question. And I struggled with this. At the seed stage, it's such a crapshoot, right? It really is, because traditional tools of valuing a company are based on discounted cash flow, and you obviously cannot do that when you have no cash flow, or your cash flow is negative. And I think what we ended up settling on is I would talk to 2 or 3 people who are, I'd sort of call like safe, and not safe like the safe node, but just like sort of safe, where you have a safe space to talk about this. Like maybe it's other entrepreneurs, maybe it is an investor who's friendly to you, and just say, what's reasonable to expect. And I would look at benchmarks, right? So I think most seed rounds are happening. It's a very broad range. I think seed rounds are happening at sort of between 4 million and 20 million cap today. 20 million is if you just had a massive exit and you're raising for your second company, like that's you can raise at a $20 million valuation of seed round. But I'd say, and if you're a first-time founder, not in Silicon Valley, nobody's heard of you, the company is not in a quote unquote sexy sector, then you may raise at 4. Most probably rounds are happening median. I don't know, you might have window into this, Nathan, but I think most rounds are happening at probably between 6 and 12 first seed rounds valuation. But I think the bigger thing is also, I wouldn't worry too much about valuation for the first round. It's really, outcomes tend to be binary in the world of entrepreneurship, right? So don't over optimize for valuation. Make sure you get the capital in and can get to, again, fundraising is a means to an end. Make sure you get the capital in and can get to the goals you need to get to. Yeah.
Yeah, I think partly you can back into it if you're raising X million dollars and the investor is expecting 20, 30%, you can kind of back into what that valuation needs to be so that you get your million and they get their 25%, right? I think, as Gautam mentioned, it is also kind of a crapshoot. It's sort of an art versus science. I'm thinking back to our seed round, the VC in the middle of the domain says, what's your valuation you're shooting for? And you just pick a number. I said 5 million, straight face, don't blink. And that's what you go with. I mean, it's kind of like Gautam said, find what the ranges are for your geography, your stage, your level of traction, and all the other factors that go into this, and then just kind of pick a number. Optimize. I've heard this. So I'm going to tangentially do a plug for this podcast. We've done this podcast that Gautam was on called How I Raised It. We've got about 160 plus interviews on there. Almost to a T, people say optimize for finding the best fit investors, not for valuation. And there are even other terms they sort of put before valuation.
Totally.
So optimize for your best fit investors. Don't worry as much about valuation.
Yeah, 100%. And I'll give you like a quick proof point on that, right? So there's like a company called Color. I don't know if most of you would not have been around them. They raised a seed round at a $40 million valuation. It doesn't even exist anymore, right? Like they flamed out like 9 months later. Dropbox raised their seed round at a $4 million valuation. And look at them today. They're a, like $10 billion plus public company. So just don't worry about first round valuation.
If you're picking good investors, they're not going to screw you on valuation, right? So again, optimize for good investors, investor fit.
Yeah.
So well said. Thank you both. And I think we're actually at time. So to wrap up for today, before we hop off, everyone, please fill out the survey that is in the chat. And if you have questions, we absolutely have them in the queue and we will send them over to Nathan and Gautam. We'll see if they can give us some answers to those. Thank you, Gautam and Nathan, so much for taking the time to speak to our community, to share your insights, and to set such a great overview. On behalf of Nasdaq Entrepreneurial Center and everyone in attendance today, we sincerely thank you for joining us.
Thank you. That was
Awesome.
great.
Thank you.
It was fun.
Thank you both. So for everyone still here, we would love for you to join us for our upcoming webinar events. Thursday, October 29th, which is tomorrow, M&A Bootcamp, the ultimate guide to mergers and acquisitions for startups. And additionally, Thursday, November 4th, Founders Leadership Series with Julie Wainwright, CEO of The Real Real. And if you have additional questions about funding, we have an alternate funding pathways webinar coming up on November 5th. We hope to see you all there. And again, thank you so much for joining us today. We're so grateful for your attendance and for Nathan and Gautam's expertise. Have a wonderful afternoon.